right, welcome back to Financial Clarity for Doctors. My name is Corey Janoff, joined as always by Rachelle Vanderzanden.
Hello.
And September is Life Insurance Awareness Month. And
So
if
exciting.
our timing is right, this will publish mid-September, I think. Um, but yes, very exciting. I'm sure all of you are eager to celebrate Life Insurance Awareness Month. But today we're going to be talking about all things life insurance. So reasons for getting it, both personal and business, the process, different types, what to look for, considerations, scenarios, etc. So yes, we'll admit, not the most exciting topic, but as you all are most likely adults, it's an important thing to do as adults, having life insurance. If you've got a family or dependents or people that would be impacted by your death, it's definitely something uh, to consider if you don't already have it. And if you do already have it, periodically review, make sure you have an appropriate amount, that it's going to last long enough and help you accomplish your overall financial objectives. So, where do we want to start, Rachelle?
Round. Background's fun. Now, all of this is morbid, honestly, but we have to talk about it anyway. So, just some stats for you. According to the Social Security Administration's actuarial life tables, super fun. For 30 and 40-year-olds, there is a greater than 90% chance that you'll make it to age 60, which is not super old. But that means that there's almost a 10% chance that 30 and 40-year-olds will die before age 60, which is also a super big bummer to think about. Women have slightly better odds of survival than men. Life expectancy is a little longer. And these are averages. So that's important to note. Like averages can be skewed. If you're healthier and or wealthier, the survival odds are greater. Life expectancy is actually highly correlated with income, which makes sense. You know, you can eat healthier, you can afford time to like exercise, all of those kinds of things.
Gym membership,
So,
healthcare costs.
yeah, I think most people who are young and healthy think of themselves as invincible, and no one is. Like everyone, this is going to be the worst to say out loud, but everyone dies at some point. You're probably not going to die before age 60, but it is so important to be well prepared for that small percentage chance that something happens. We don't want your dependents and your loved ones to be financially in a tough spot when they are in such a tough spot emotionally. Like obviously the death of a parent or something like that is incredibly devastating. And if we can at least take care of the money side of it, that can be really helpful.
And you guys, as a demographic, have probably seen almost as much death, if not more death, than anyone else out there. You know, doctors see people, I guess, depending on your specialty, literally dying in front of you on a daily basis in many cases. And you see the family members and that impact and the emotion that goes into it. And Rochelle and I see a decent amount too. I mean, everyone has had loved ones or acquaintances, friends, family members, etc., pass away. You know, we get to see it not only from that perspective, but from the financial perspective too. Like we've all had some clients either pass away or their spouse or a parent or a sibling or family member. And we can see when life insurance has been greatly beneficial and when it was an
Would have been
opportunity.
beneficial.
Yeah, would have been beneficial. Like we've seen
Yeah.
scenarios where someone had life insurance, passed away, family could continue on without having to make drastic changes. You know, spouse could afford to retire in a timely manner. We've also seen the scenario where it's like, man, if you only had gotten life insurance when you were younger,
We
like
could.
this could have, prevented a lot of the aftermath that you're experiencing and having to, you know, change things around financially. So,
Yeah.
um, yeah, it's not fun to talk about, but also important. And it's, I've had some clients have some health scares that have, told me, hey, do your job and make sure people get this stuff because like I've seen my life flash before my eyes and this is important. We don't think it's going to
Hmm.
happen to us because we're young and healthy, but it could.
Yeah.
Be
And
devastating for a family if it does.
I think the worst part is when people are like trying to do their best and they really just waited too long. Like that's so hard, especially, when people are trying to plan for something because they have a diagnosis that's not great, and they're like, "Oh, let's get some life insurance." I'm like, "That would have been a good idea a year ago or 2 years ago." But now we can't. We can't do that. So that's probably like you don't want to be dealing with that kind of situation where you know that life insurance will be really helpful and no one's going to give it to you because they also know like they will do some medical review. They will find out. So I think we've touched on this a little bit, but there are lots of different reasons for life insurance, and protection is the biggest one. That's what we're kind of talking about right now. Financial protection for dependents, kids, spouse. If you're sharing expenses equally at home and kind of relying on your income and their income or only your income to make that financial picture work, like that's a big deal. Maybe parents. I think a lot of times folks have parents who have supported them along the way and they want to make sure that they can support their parents as they get older. So that's another great reason to have life insurance. The objective at that point is financial stability so that they don't have to make any drastic financial changes if something happens to you. You don't want to have to like sell the house or change schools or adjust lifestyle dramatically or revise retirement plans because we are down in income. Like we want to make sure that things can be as stable as possible if some sort of untimely death happens, because that's going to create less challenges, at least on the financial side. We don't want to be dealing with emotional devastation and having to sell a home and move and change schools and things at the same time. I think even coverage for like a stay at home partner or spouse can be really important because that person's contribution in the household is really hard to measure, but it's very big. And it can also affect the working partner's ability to work. If your stay at home partner is no longer around, and now like we need to make changes in order to be able to take care of the kids and things like that can affect your ability to earn as well. So I think a lot of people downplay their own contribution to the family and to the household when they're a stay-at-home parent, and that's not something you should do. Like that's a real thing that we can work through, at least in just kind of an idea in our head, like what would this look like if this person passed away? It would be different dramatically and have some big economic impacts.
We didn't even think like if you're a doctor, you have a stay-at-home spouse. I mean, you're making a good income. You could afford childcare if your spouse isn't around. But I don't know, maybe you want to like take an extended leave of absence because you just lost your spouse and you need some time to just breathe and think and refocus your life. And it might be several months or even a year. And if you have sufficient influx of cash to afford that, you have that option. You don't have to, but I don't know. Who knows what it'll be like if you pass away. And it can definitely help with maybe you want to, scale back at work, like Rachelle said, to be with the kids while they're young, make it to their soccer practices and, be there on weekends. So, instead of taking weekend call, be like, hey guys, I'm taking a pay cut. I'm not going to work as much, going to be there for my kids. So you'll have
Yeah.
that option if you got coverage on your stay at home spouse. Business reasons often overlooked and not applicable to everyone, but for business owners especially, definitely a consideration in certain circumstances. Anyone looking to get a business loan is most likely going to need collateral of assignment in the form of life insurance from uh, the bank's going to require that on a lot of loans if you're starting up a practice or, for part of your practice, even if it's not a loan to start things up. So essentially you die, bank wants their loan money back. So you get a policy that pays off the loan for the duration of the loan. Pretty straightforward. Key man coverage. So a lot of companies have certain employees that it would be really difficult for them if they were to lose that employee, and they'd be challenging to replace. So you can buy life insurance. The company can buy life insurance policies on those key employees. It's often called key man insurance. Um, or maybe key person insurance nowadays to be more politically correct. But it's essentially we lost a key person. We need some money to shore things up while we find a replacement, which could take months or even a year potentially. Or if that person was a big driver of revenue, we're going to have a loss of revenue while we find someone that can replace them. Uh, Operating and buy sell agreement. So you're in a partnership with one or multiple people. One of the partners dies. First and foremost, get an operating agreement with your partners. Anytime you're starting a business, get the contract drawn up. How are we operating together? If any of us are to leave the business due to retirement, due to move, career aspirations, changes, whatever, we're leaving the practice, how are we buying out each other's shares? And that could also come in place in a death or permanent disability. So in this case, in the form of death, if one of the partners dies, their spouse or family probably doesn't want to have a stake in the business and be owning the business. You probably also don't want to be in business with their family, non-doctor family members who don't know anything about medicine. In some states, non-physicians can't even own physician practices. So to make it simple, we give family money, family gives us shares in the business, everyone's happy, and we retain control in our business and don't have to deal with their family members. So make sure that's all written out and reviewed and revised as time goes on. How are we going to value the business? How are the shares going to be purchased? Is it just going to be a lump sum of cash right out of the gates? Is it going to be a 5-year installment? Doesn't matter. But oftentimes, if the business is valuable enough, that share purchase, not everyone has enough cash lying around to buy those shares from the deceased partner. So they'll fund that purchase with life insurance. The partners buy life insurance on each other. So if one of them dies, family gets money, surviving business owners get the shares in the practice. And it's clean and easy. And, I've seen this, personally. I know someone who there were 4 partners. They're varying ages. One of the partners is retired. One of the partners passed away a few years ago, and his wife inherited his share in the business. They also own an office building. The 2 remaining partners, so all 4 of them own this office building. 2 people still working, 1 retiree, 1 former owner's spouse. The retiree and the spouse want to get out of the office building. The 2 remaining owners want to make some renovations to the building. And again, the retiree and the spouse don't want to put any money into this building. They just want to cash out and move on with their lives. There was no buy sell agreement in place. This was just, your classic, good old boys club where the 4 guys handshake agreement, let's all buy this building together type of thing. But now that there's not really a formal agreement in place and people have different objectives with what they want to do with their stake in the business, it's getting a little messy and they got to get lawyers involved and whatnot. So make sure you have the legal documents in place and you have a plan in place for if someone wants to leave and how it's going to be executed. And again, in the case of a death, life insurance could be useful. Buy out that spouse because she doesn't want the office building. She just wants the money. So,
Yep. Life insurance can also be helpful for estate planning purposes to help provide liquidity and maybe pay some taxes. So a good example is if you own businesses or real estate that you would like to pass along into your heirs, but maybe those businesses or that real estate has debt associated with it. You can use life insurance to pay off the debt on those owned properties. And that way your heirs aren't responsible for that. They just get the asset outright. It can also help to divide inheritances equally. So if you have a property or like your house, perhaps that one of your children would like to live in, but you would also like to be able to divide your assets equally between your 2 children, it could be helpful to have a life insurance policy for that second child that doesn't want the house so that they have something that's of equal value. And it can be a little complicated, but obviously, there's going to be some movement in like the price of the house and things like that, but it doesn't have to be perfect. Like this is something that you are doing for them. It doesn't have to be perfect. It can also be helpful with estate taxes. So federal estate taxes apply currently if your net worth is over 13.61 million at death. It's 27.22 million for married couples as of 2024, but that exemption is set to decrease by 50% in 2026 when the Tax Cuts and Jobs Act sunsets. From that's only through 2025. So if you have an estate that's valued higher than that dollar amount, then you have to pay that federal estate tax. But it could be, again, that those assets aren't super liquid and we have to sell a whole bunch of stuff in order to pay taxes. And we don't want to do that. So you can potentially, have some sort of life insurance policy to create some liquidity in that estate to pay those taxes and not have to get rid of a bunch of assets. There are also some state estate estate taxes that are sometimes due just depending on what state you live in. There's about 12 states plus the District of Columbia that have a state level estate tax. So that's another one you want to plan for if you live in one of those states. It's actually one of the few taxes that California does not have. So give yourself a little pat on the back if you have an estate in California. It does. Florida is another state that doesn't have one. So partially explains why many wealthy people from the Northeast tend to retire in Florida to kind of dodge more taxes.
A lot of the
Corey and I,
northeastern states have state estate taxes, like Connecticut,
yeah,
Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode
Oregon.
Island, Vermont, and Washington.
Yep.
So yeah, if you live in New York, Maryland, Connecticut, Massachusetts, let's go retire in Florida. Sunny and
No state
no,
income taxes,
no income taxes, no death taxes. Some
but you live in
weirdos.
Florida.
Anyone who
So
lives in
that,
Florida, we love you, but
yeah, exactly.
you know your reputation.
You can, you might, yeah. People love it there though. It is beautiful.
Yep.
I love the Taylor Swift song Florida. Makes me happy. Just so
I
everyone knows.
love the Carl Hyacin books. If you've never read
Ooh,
Carl
I have
Hyacin,
not.
they're phenomenal. He's hilarious. All of them are set in Florida, and it's like they're all like murder mysteries that
Like Dexter.
I never watched Dexter, but I mean, they're just your classic, thriller
Mm-hmm.
novel where it's fast paced. There's, trying to solve a crime, but it's comedy the whole way through. And a lot of it, Florida's just the punchline of all his jokes. He lives in Florida, so he's.
So he's allowed to make fun of Florida. Okay, anyway,
Mhm.
moving on. We should stop making fun of Florida ourselves. So, one other purpose for life insurance is potentially to accumulate value. If you have permanent life insurance, you can build value in a policy over time. It's really complicated. It's one of those things where, if you're considering a permanent life insurance policy, especially if you want to accumulate money over time, you should spend a lot of time understanding it. Like that's probably the biggest thing I would say about permanent life insurance is like do your research, make sure you understand the ins and outs of it like crazy. You can basically try to overfund permanent life insurance beyond the minimum required premium payment, which would just kind of satisfy that insurance need and like make sure that you have coverage for as long as you want it. And then that excess money can accrue interest or be invested, sort of, and potentially grow tax deferred. And then you can borrow money from the policy in later years, tax free, if you do it correctly. So we can borrow against the cash value and then, have another extra source of retirement funds potentially or something like that. It can work if you overfund the policy, but the max allowed is for about like 15 years or, oh, you have to, this is what it is. So you kind of need to do this for at least 15 years in order for it to make sense and for you to accumulate value. So I think that the biggest problem that I've seen with clients who have permanent life insurance policies is that you're not necessarily super committed to it. You're like, why do I have this like 3 or 4 or 5 years later? And if you then pull the plug on it, you didn't make any money. Like if your plan was to make money on investments in that policy or like to use it to accumulate value or over time, and you pull the plug after like just a few years, you're not making any money. You just wasted a bunch of money. So it's a big, big, big commitment that requires many years in order for it to pay off. So just make sure that you're ready for a big commitment if that's something that you're considering.
But if it's done right, and if you utilize it for the right purposes, then yeah, it can be a good way to grow assets in a tax sheltered manner. Also provide death benefit for your family. In certain states, it's a very highly protected asset as well. I think
Like a
Florida.
retirement account, kind of.
I think Florida is one of them where it's hard if you get sued to go after the money in those accounts. But yeah, definitely not for everyone, but can make sense for certain individuals in the right circumstances. But I think general of order of operations with investments, max out your traditional tax advantaged accounts first, like the 401k, 403b, backdoor Roth, etc., and put a healthy amount into a regular brokerage account that's more flexible. Doesn't have the same tax benefits, but definitely allows for more flexibility. And then kind of look at that's when you can start exploring some of those alternative investments. And I would kind of view that life insurance, if it's done right, as almost like a bond portion of your portfolio. If you're using like an index life, for example, because it's essentially a fixed interest type of account. Whereas like a variable life has more fluctuation because you're in quote unquote sub accounts or mutual funds, and those can be a little more risky because if they go down in value, you might be underfunded in your policy. So anyways, we're getting into the weeds here. If you want to talk about permanent life insurance, reach out to us. Or I think we did an episode on that a while back.
I think we did.
But
Yeah.
again, yeah, go listen to the previous episode. Not for everyone, but could be for some of you.
Yep. Proceed cautiously, learn a lot.
Mm-hmm.
As far as getting life insurance goes, so we're talking up like you should get some life insurance, and everyone says, how do I do that? Well, there's a process. Normally you have to, find a carrier, and an advisor can potentially help you with that. Sometimes you can just do it online, but you do an application and you have to answer some health questions. If there's any questions that they have on like the health questions that you've answered, they may record or order some medical records so that they can review those. You generally have to do an exam, and they'll like draw blood and take a urine sample and all that kind of things and run labs. So you're not really going to pull one over on anybody, just so you know. There's also lots of questions about like, do you do anything risky? Are we jumping out of planes? Are we scuba diving? Are we traveling to war torn countries? Like all of those things can potentially affect the cost of your life insurance as well. It's easier to qualify the younger and healthier you are. So if this is something that you think you need now, or you think you may need in the future, it could make a lot of sense to apply for it when you are young and when you are healthy. Any medical history could be a red flag. Any like slight abnormality in your labs can be a red flag, even if it's not like if you're almost high cholesterol, it's probably going to be a higher rate. They're not looking at like how healthy are you right the second. They're looking at how healthy are you going to be for the next 20, 30 years. So that's what they're trying to look at. There's also other things that could potentially impact the cost, like therapy, counseling, like mental health considerations, chiropractic visits. I feel like that's a bigger one for disability insurance, but also for
Yeah,
life insurance, Corey.
I think mostly DI. You're probably right.
Yeah,
But if you have
because
like I guess depends on the nature of the thing. That
yeah,
basically
totally.
anything in your medical history, they do script checks. So if you've taken
Yeah.
medications or
Ooh,
prescribed yourself
driving
stuff,
records. They pull
driving
driving
records too.
records too. I have definitely had that affect clients in the past. I'm like, what are you doing? Why have you gotten 3 speeding tickets in the last 6 months? They're not very happy about that. They're going to charge you more for your life insurance. You should stop doing that.
And all
But
these things, it's not necessarily going to prohibit you from getting it. There's just a
mhm,
really long sliding scale of costs. So like if you're willing to,
mhm.
I mean, sure, there are certain conditions. Like if you are currently going through chemotherapy for cancer, yeah, you're uninsurable. But there are companies that will take you on as a policyholder for a cost. And it's like there's a table that literally goes through pretty much the entire alphabet, A to Z. So like if you could either have super healthy ratings, above average health ratings, and then below average from A down to Z, or 1 to 26. Maybe it's not quite that far, but I've seen it go pretty far where it's like, hey, we're charging you an extra, $1,000 per $100 of benefit, and that's maybe a little extreme, but like I've seen some
Slight
pretty
exaggeration.
extreme example or quotes where they're like, yeah, you're approved. It's just going to cost you an arm and a leg to get this coverage. And yeah, if you die in the next 20 years, it's worth it for your family. The math pencils out, but it's a
Mhm.
hefty price tag for this coverage.
Absolutely. Yeah. So, yeah, bottom line, when you're healthy, healthiest, most of us aren't getting healthier. Like, that's a good time to apply. Even if you have existing health conditions, like, you should apply now because if that condition gets worse, it's going to be even more expensive. And I've
And
definitely had that happen as well, like with diabetes and things like that. There's a progression with a lot of these more chronic illnesses.
and if it's a more recent condition or diagnosis, like the insurance company will tell you, like, hey, we don't want to approve you now until after these tests have been done or after a year of no further treatment is required. They like to see stability and time elapse with any conditions. Um, and it's something like you can kind of if you have any questions about your medical history, like you can kind of run run it by an underwriter more or less. So that's where an advisor can be helpful because they can kind of do a preliminary uh
Do
inquiry
some
for you.
poking
Hey,
around
we're not
before
actually
you apply.
applying, but we're going to kind of submit this scenario to the underwriter. Because if you're declined, you do have to disclose that on future applications, and they have a record of it. There's like it's the multiple insurance bureau, so they can see if if you've applied for other companies, if you've been approved or denied with other companies. So like if you've been declined, there's no hiding it, and they're going to want to dig into why you were declined. So
Yep. One other thing to keep in mind is that pregnancy can sometimes complicate life insurance applications. Sometimes it's absolutely fine if you have like the easiest pregnancy possible, but especially if you end up, having gestational diabetes or preeclampsia or something like that, any of those more serious things, that can be a big deal for life insurance. So if you're considering having a little one, or if you are early in the stages of pregnancy, get it now. Now.
sooner the better.
Yes, always. Okay. So then, if you've decided you need life insurance, then you decide on what type of life insurance you need. We touched a little bit on permanent life insurance and how it can build cash value. The other kind of life insurance that is available to most people is called term life insurance. Term insurance is temporary. So it's designed to last a fixed number of years or can potentially expire at a certain age. And that's most appropriate for most people. It cover you while your kids are still fairly young and dependent on you, or until you kind of reach financial independence or a combination of those two things. So 20 to 30 years is sufficient for most people. In 20 to 30 years, your financial picture looks very different. In 20 to 30 years, your kids are hopefully a little bit more independent and don't rely on you to provide them with money, hopefully, again. But even if they do, you've been saving for retirement for decades at this point. If you pass away, you don't need retirement money anymore. So there's a lot of different ways that those assets can be used at that point, even if you don't have life insurance. Permanent insurance can last indefinitely. We don't want to say permanent life insurance is permanent because if you don't pay for it, it's going to lapse and you're not going to have it anymore. But as long as you continue to pay the premiums, or the policy has sufficient cash value in order to pay its own premiums to kind of cover it's like the cost of insurance internally, then you have life insurance. It is much more expensive, which is why term life insurance is appropriate for most people. But if you want life insurance that lasts forever, the life insurance company knows that eventually they are going to have to pay someone a death benefit, and therefore they have to charge more to make it worthwhile. Also, like if you're trying to build cash value inside of that plan, it costs even more because you have to be putting extra money into that policy in order for it to make sense.
Yep. But yeah, some people will intentionally do that, like get a policy for whatever reason. We just want to leave money behind to our family, estate planning, business, you name it. Let's overfund it in the first 10 or 20 years to the point where it's considered paid up to where you don't need to pay anymore. It's going to last forever based on the cash that you've stuck in the reserve account within the policy. So that is a strategy for some folks. Some people even do a single premium pay where it's like guaranteed to last forever. We've seen that with it's more so in the estate planning realm. Like, hey, just sold my business, want to create liquidity for my family, estate planning purposes, blah, blah, blah. I'm going to just write a check for $250,000 to pay for this life insurance and never have to worry about it again. And then whenever I die, my family gets whatever that death benefit is. So, and that,
Yep.
like, some premiums could be more. Like, I mean, you could get like $100 million of life insurance. Your premium might be $30 million. All right, cool. That's great. If it
And
works
that's
for
what you
you.
want to do.
Yeah, that's what you want.
Yeah.
But when does permanent life insurance make sense? I mean, we kind of already talked about it. It often gets a bad rap because it's often used incorrectly and oversold by life insurance agents that are paid by their employer to sell more life insurance and more expensive life insurance. So that's where it's important to, which we'll touch on in a little bit, go through an independent agent or advisor that's not affiliated with a specific company. But even some independent agents, are incentivized to sell the more expensive policies. So you got to ask a lot of questions if you're being pitched it. But if structured correctly and utilized for the right circumstances, like we covered, it can be beneficial. The most common ones are estate planning, a business buy sell, where you don't really have a definitive time frame on when you need that coverage to last for. Um, or potential cash accumulation purposes in conjunction with the death benefit.
hmm When you're thinking about getting coverage, a lot of people are like, what company should I go through? Like, who should I ask about this? I think, you know, you want to do a little research and preferably work with someone that's independent and can work with a lot of different carriers so they can shop around for you, kind of look at the different carriers and what the potential costs might be, especially if you have some unique medical circumstances or other risk factors that can be really helpful as well. And you don't want them to have any ties to like a specific insurance company because that will lead them to recommend that you buy insurance for that company. And that's not what you want. You want someone to be able to look around for you. When you're looking at the companies, it's like we want strong company financials, we want competitive rates for term life insurance, we want competitive permanent policies that do the thing that we want them to do, whether it's like building cash value or just making sure you have the life insurance benefit whenever you do pass away, whatever it is that you're looking for, just making sure that that company does a good job of that. When we're thinking about like what and when to get like term life insurance policies, while you're young and healthy, you can get them and be fairly low cost, fairly competitively cost. But we also want to maybe look at a term policy that we can convert into a permanent life insurance policy later on. And that can be really powerful to have in your back pocket. Just, hey, maybe I'm not ready for permanent life insurance, but this is something I want to be able to consider. And when you do that, like that term life insurance policy then has your health rating or whatever it is. And when you do that conversion, they will assume that you are just as healthy as when you secured that original term policy. And that's the benefit of it. We don't have to go back through medical underwriting to now get permanent life insurance. We can get it potentially at a lower cost because they're going to assume we were as healthy as when we got this term policy. Some companies also now offer like a hybrid long-term care and life insurance policy. So long-term care can be very, very costly as we get older. And this is something a lot of people are thinking about, which can make sense if life, if that long-term care is a consideration, those policies can be really helpful in like kind of a cost-effective way to get some long-term care coverage.
And in case you don't need the long-term care, your family gets the death benefit when you pass away. So that's
Mm-hmm.
a big concern about people with long-term care insurance is, hey, I'm going to pay all this money into something that I may or may not need, because you don't know if you're going to need long-term care, but we do know that you're going to die at some point. It's just a matter of when. So it kind of ensures that you get your money's worth out of the policy one way or the other.
Mm-hmm.
Now, how much life insurance to get? Per usual, Rachelle, it
It
depends.
depends.
Probably should get more than you think. There's plenty of
Yeah.
online calculators out there that you can play with, but you could also just start working backwards all right, what might I need? So let's start with our debts. All right, let's pay those off so our family doesn't have to worry about them. And if you die, your family doesn't have to pay off the mortgage right away. They could continue making the monthly payments, but if you're no longer around, that might be a challenge. So you could either pay it off in a lump sum with the life insurance proceeds or just pay it off over time with the life insurance proceeds, one way or another. But mortgage and other debts, student loans most likely will be forgiven if you die, unless they were like co-signed by someone else, but case by case in that scenario. Um, and you got to factor in childcare costs, raising the kids, college expenses if you want to pay for college, annual living expenses needed for your spouse, presumably for the rest of their life, unless you want them to plan to remarry and find another spouse.
Or support themselves, Corey.
Yeah, that's or support themselves. And you can, then subtract out if they're earning income. All right, we figure out what we
Yeah,
need for living
exactly.
expenses, subtract out what the surviving spouse will continue to earn for a working career.
Hmm.
Um, but but yeah, so hypothetically, let's say maybe the lump sum needs total $1 million, the mortgage, debts, and anticipated college costs. And let's say you want to provide the equivalent of 10,000 a month for living expenses. And we'll just pretend, it's 10,000 a month, the spouse doesn't work, or maybe you want 20,000 a month and the spouse makes enough to support half of that. Whatever. So 10,000 a month living expenses, 120K a year for the rest of that spouse's life. Say the spouse is 35 now. We want to provide that for, call it, another 60 years, get them into their mid 90s. So if we do a present value calculation, depending on the interest rate we use for the growth rate of assuming we invest the life insurance proceeds and slowly draw from that over time, you're going to need about 2 to 3 million to provide 60 years worth of 10,000 a month of living expenses. Now, if we adjust that for inflation over time, because 10,000 a month today is going to be more than 10,000 a month in the future, then we're going to need over $4 million to provide that income stream. So here we go. Long-winded way of saying we need about $5 million in this scenario to pay off the mortgage, send a couple kids to college, and provide a modest income, by modest by doctor standards, income for a surviving spouse, um, for their remaining anticipated time on Earth. So, like I said, for a lot of people, it's probably more than you thought you might need. $5 million,
Hmm.
dollars, and that's like not a crazy amount either. So,
Yep. A lot of times we talk to clients and they're like, I have life insurance at work. And it's like, not enough. Like, that's great. I'm so happy that you have some life insurance at work. But they don't often provide very much coverage. Definitely not $5 million worth of coverage. Like, absolutely not. Yeah. Maybe like one time your salary, maybe if that. Yeah, and so that's something that you want to review in your benefits at work, but you also don't want to count on that because every year they change benefits. Even if you don't change jobs, they're reviewing the insurance or like the benefits that they provide their employees every year.
and your need is going to change over time. Maybe you have more kids, maybe you get a more expensive house. Kids get older and move on and they're not dependent on you anymore. Your savings grows to where your life insurance need decreases. The
Mhm.
As you get older, the amount of time you have remaining on earth decreases. So therefore the amount of money you need to sustain your remaining life will decrease. So it's not a static number. It changes over time. But for most people, the need is greatest early on in their career when the family's young, they don't have a lot in savings built up, and that need, it might, slowly increase in the early years, but then, it starts to decrease over time as you accumulate more savings, as you pay down your debts, as your kids get older, as you get closer to achieving financial independence. So when you're young, get a lot. As you get older, you can
Hmm.
revise. And there's a bunch of strategies like getting multiple policies that expire at different times, but it's something that you definitely don't want to look at in your late 20s, early 30s and then say you're good forever. Maybe you are, but it's something you want to periodically review over time. And if need be, you could potentially apply for a newer policy that's more appropriate in the future, as your life evolved. And hopefully you're still in decent health and you can get approved at favorable rates. Or you could cancel some of your coverage as your needs decrease over time. But yeah, good to review it from time to time.
Absolutely. I think bottom line is this is one of those morbid but necessary conversations, just like estate planning and making a will and things like that. Life insurance is kind of the same, but yeah, we're gonna steal a quote here.
From a person
Todd.
that you don't know. It's a
Yeah.
guy named Todd, but
Oh, Todd. But like with everything in your financial plan, like the goal in general when we're doing financial and planning is to provide strength and comfort, not worry and stress. So we're not talking about these things to stress out. We're not talking about them to make people worried about dying. We're talking about them so that you know there's a plan in place and you don't have to stress about it. If you have a bad medical diagnosis, you know, like the money side of it's taken care of. We can focus on the medical side of it. We can focus on getting better. We can focus on enjoying the time we have left and things like that. Ugh, so sad.
yep. But important.
Absolutely.
Thanks for listening. We'll see you next time.
Bye.